It's just then if you have any extra questions, any exercises you'd like to look together, or any slides you want me to go back to, then that's what the second hour is for. Now, 1 second, let's see if, there we go. So, well, as Jordan already said, a few disclaimers. EHL Recap is not affiliated with EHL, and more importantly, I love to do predictions about final exams. Sometimes they're right, sometimes they're not. But any prediction I will make are based on my opinion and on the exercise I have done, on the exercises that Turkey has provided us, being that mock midterms or mock finals. So this is what I think that will be on the exam. Might be the case, might not be the case. We'll see. And of course, after this session, I expect you guys also to study, do some more exercises, and this is just then the basics of MA. There are some extra things which I will not cover, mainly for time reasons, but it's really small details that I think will not be on the exam. We'll see, but it's really minor things, and you can easily look them through. Now, starting then with the introduction, it's just a quick go-through. So the difference between management accounting and financial accounting. So mainly management accounting is something that firms do internally. It's not mandatory, and there's no rules to follow. Any firm can do whatever they want. They can follow any template they want, any form, anything. It's just based on internal rules. So they don't follow any official rules, and therefore they're not audited. Mainly, managerial accounting deals with predictions. They create budgets. They control these budgets. They see the variance between the budget and then the actuals. And what's the main reason why management accounting exists is it's used to control and to make decisions. So because they budget, they look into the future, they can see, oh, this product will probably not do so well this year. Should we maybe cut down on production? So that's all things that MA does. While financial accounting, as we saw in BOSC 1, it's mainly for external people. It follows very, very strict rules. Remember, guys, the gap. It's audited. There are some typical auditing firms. And the big difference between MA and financial accounting, other than who the audience is that financial accounting shows the past of a firm, while MA shows the present and the future. And as I said, financial accounting used to show the current and past financial information. Shun is a bit cut out. Now, starting with the actual application parts. So if you guys have questions about any slides, please ask them at the end of each slide. Not to interrupt. And if you have any questions, just ask them at the end. You can unmute your microphone or chat however you want. I will have some exercises where I will ask you, for some, please use only chat, and for some, only microphone, but don't worry about that. Once they're there, I'll let you guys know. So the first section is mainly about costs. There's the first type of cost is called manufacturing costs, also known as product costs. So manufacturing cost are all the types of costs that go into making a product. That could be any product that's manufactured in a factory. That could be a service also. Anything that's sort of a product is a manufacturing cost. And that's divided into three parts: direct material costs, otherwise known as DMC, direct labor costs, known as DLC, and manufacturing overhead. So starting with DMC and DLC, those are the cost of materials used in productions, which is DMC, and DLC is the salary of the workers that work directly on the factory floor, actually creating the product. Well, the cost of materials is the actual cost of the material used. Let's say, for example, to make a water bottle, one direct material cost would be the plastic of the water bottle. Well, the manufacturing overhead is literally anything else that is used in the factory. That could be the lighting of the factory, the disinfectant spray to clean the machinery used. It could be the food served in the factory cafeteria. So anything that happens in the factory is manufacturing overhead, but it has to happen in the factory. It can't be something that happens, let's say, in the headquarters. And finally, as we saw also in BOSC 1, prime costs, it's always labor costs plus COGS. COGS in this case is direct material costs. Then the second type of costs are called non-manufacturing costs. These costs are anything that's done outside of the factory. So typically it's the business administration stuff like marketing, sales, administrative, the cost of the managers that work in the headquarters, the CEO, HR, anything that's outside the factory related. For me, very easy to remember. If it's taught at DHL, it's probably a non-manufacturing cost. Meaning that, let's say, for example, what's taught at DHL? Marketing is a non-manufacturing cost. Financial accounting, the salary of the accountants is a non-manufacturing cost because it's everything that happens outside of the factory. Then, to find the different types of costs, there's something called a schedule of costs of goods manufactured. It's basically a step-by-step process to find all of these different costs. So the cost of raw materials, the total manufacturing cost, the cost of goods manufactured, and the cost of goods sold. Now, it's a much longer step-by-step process. It's actually this. I would highly recommend to put this on your cheat sheet, since all the exercises that he has, as of right now, given us, when he asks us, for example, to calculate beginning raw materials inventory, or please find the direct labor cost, you have to use this sheet to then find the different costs. For example, let's say he tells us, find the direct labor cost. You have the raw materials and the total manufacturing cost, for example. So you do the total manufacturing costs minus the total manufacturing overhead costs and minus the raw materials, for example. And that way you find the direct labor. So this is the amplified schedule of costs of goods manufactured, and it will be very, very useful for every single exercise that there is based on different types of costs. I personally do not know it by heart. I would not recommend studying this whole thing by heart. Just have it on your cheat sheet, and whenever he asks you to calculate one of these costs, take it out and use it. That's the best and most direct way to do then these kind of exercises. Then there's also two other types of costs called variable costs and fixed costs. We all know what those are, so I'm not going to talk about them much. The most important part that you need to know for MA is that variable costs per unit always stay the same, while the total variable costs increase as production increases. So again, back to the water bottle. If we make, instead of 100 water bottles, 200 water bottles, then we obviously need more plastic. So the cost of plastic increases as the production of water bottles increases. Then there is two types of variable costs. One is a true variable cost and one is a step variable cost. A true variable cost is a linear variable cost, meaning that as production increases, so does variable cost. So if we increase the production of one water bottle, the variable cost will increase also by one, very linear. Well, while the step variable cost, it increases in batches. It's usually used for stuff that needs to be ordered in bulk. For example, for material that's very rare, or usually also when creating phones, there's different materials used inside in the logic board that need to be ordered in bulk because they come from far away. And there, for every bulk order, the variable cost increased. So it's not really based on production, but it's based on orders. So it's done in steps. So the more you order, the more bulk you order, the higher the variable cost, which is why it's considered a step. Then there's the other part, which is called the fixed cost, which is the total fixed, which is, as you know, fixed costs, they never change with production. Now, the total fixed cost never changes, while the fixed cost per unit, they decrease as production increases. Since the fixed costs are always the same, the more you produce, obviously, the less fixed cost is going to be. Now, there's two types of fixed cost. That's what Turkey showed in his slides. The first one is a committed fixed costs, which are fixed costs that are hard to change. So, for example, if a company buys a new building, it's kind of hard to quickly sell the building and dismantle it. So committed fixed costs is anything that's really hard to change, while discretionary fixed costs is stuff that can very easily be changed with one simple decision. A good example of this is training. Let's say you need to train your workers and you realize, oh damn, I don't have enough budget for that. Well, it takes one very quick decision to quickly cancel the training and postpone that to next year. Then finally, for costs, we already saw this in F&B management in Botswana. But in case you guys don't remember, quick reminder. So direct costs are costs that can be attributed to a particular product. While indirect costs are costs that cannot be attributed to a particular product. Typical indirect costs is rent, electricity, heating, because there's not one specific product that uses all the electricity, but in a factory that creates many different products, the lighting, for example, that's considered electricity, that's used for many different products. It's not just one product. Direct costs, again, the plastic for the water bottle, it's used for one specific product, and which is why it's called a direct cost. Then, I skipped from section 1. So section 3 is called cost behavior and analysis. He shows us, it's basically a way to forecast costs and to determine fixed and variable costs of a specific method, a specific product, and he gives us specifically 4 different methods to use it. Now, the first method is called the scatter graph method. So scatter graph method, there's no numbers involved or very few numbers involved. It's just seeing the relationship between a level of activity and total cost. The example he gives us is in a hospital, the number of patients admitted, as you can see, it increases with the cost of number of patients admitted increases with the number of patients admitted. The way to do this method is very simple. He gives you numbers. You select the numbers on Excel. You press insert, scatter graph. You insert the trend line. And then if the trend line is going upwards, there's a relationship. If it goes downwards like that, there's also a relationship. While if it does random zigzags up and downs, then there's no relationship. That's all there is to the scatter graph method. It's just seeing if 1 unit of production increases, does the cost increase, yes or no? Then the second method is called the HighLow Method. This is a method that he always puts, that I've seen for now in all of his exercises, all of his past exams. So I think it's going to be there in one way or another. The HighLow Method is a way of calculating variable and fixed costs based on a level of activity. So what you want to do is you want to take a high level of activity and so we have a certain firm that does different activities. You want to take the highest level of activity and the one with the lowest level of activity. Once after I'm done with this, we can then do an exercise together, which will be then much easier to show you. But theoretically, what you have to do is you have to take the highest level of activity and lowest level of activity. Let's say, for example, the hospital again. The hospital in January, it had an occupancy of 450 beds, which is the highest activity level. And in February, it had 200 occupied beds, so the lowest level of activity. So what you want to do is do the difference between the level of activity divided by the difference of the two costs. Sorry, inverted. The difference of the two costs divided by the difference in activity level. There you find the variable cost per level of activity, per unit. And then to find the total fixed cost, you very simply do the total cost minus the total variable cost. The total variable cost, you can find that by using the variable cost found using the HighLow method times what I usually do is the highest level of activity. It will be clearer once we do an exercise on it. It's just then theoretical right now. Then the third method is called the regression method. The regression method. It's simply the way of finding the total cost using a function. Now, as you guys know, a function is always made of 2 elements, the A element, which is the variable part, and the B element. In his case, the A element is variable cost and the B element is fixed cost. Now, what he did in the final exam is he gave us the regression analysis. The only thing you need to know of the regression analysis is these 2 parts, is the intercept and the clients. So the intercept is the fixed cost, while the under parts, which depends on the variable, it can be called clients, it can be called material, anything, but that fixed cost is always called intercept, while clients is then your variable cost. What you want to do is you take clients or your variable cost times you do that times X, and then you plus the fixed cost. And that's then your total cost function. So in this case, it'll be x times 3.52 plus 540.1. 540 being the fixed cost, 3.52 being the variable cost. Then, the contribution margin income. It's a new way of writing an income statement. So we have the two methods. First one is the classic method, the one we all love, the one we're used to, which is the one we've been told since BOSC 1, sales revenue minus COGS minus operating expenses. That way we find the operating profit. But in MA specifically, they use much more the contribution margin income statement, which is sales revenue minus variable cost. That way you find the contribution margin. The contribution margin, there's a whole chapter dedicated to it. Don't worry about it now. We'll see it together more in detail later. And then the fixed cost, and then once you find the contribution margin, you take away all the fixed cost, and that's your operating profit. All right, you'll see. Sorry guys, just want to see the chats. Okay, there's nothing. And that would be section 3. And the new method, the contribution margin income statement, it's very useful if you want to clearly define the difference between the variable cost and the fixed cost. This way, it's very easy you can separate them, use them in the exercises you need it. It's just a new way of, the result at the end is the same. You find the operating profit. It's just a different way of finding it. Now, section 4, called CVP, which stands for Cost Volume Profit Analysis. It's basically a whole chapter dedicated to the contribution margin, to the break-even point, and different ways of using the break-even point, different ways of calculating the break-even point. Now, the break-even point, as we saw with our lovely William Alexander Francois, who I missed very much, it's when total revenues equals total costs. Basically, your break-even point is when your profit is 0. And the contribution margin is equal to your fixed cost. Contribution margin is basically what you need to cover your fixed cost. Now, as we saw in BOSC 1 with William, there are 2 ways to calculate the break-even point. By the way, Jordan, is this being recorded?
Yes, it is, but I'm not recording with the Teams, that's why.
Okay, sorry.
No problem.
Now, there's 2 types of break-even point. The first one is called a quantity break-even point, which is basically how much quantity you need to sell in order to reach break-even point, in order to have your costs equal to your revenue. And the formula for this is fixed cost divided by contribution margin per unit. Contribution margin per unit being contribution margin divided by the amount that you sold. And the second type of break-even is called a revenue break-even, which is how much revenue you need in order to cover your costs, your total costs. And that is calculated by doing fixed cost divided by something called the contribution margin rate, which is what CMR is. The contribution margin rate is calculated by doing the contribution margin divided by the total revenue. It's basically the percentage over the total revenue. Having said this, classic. I hope this is fine for this. It's very simple. It's just 2 formulas, 2 types of break-even, and we'll see then later how to use them and what they're used for. Cost volume profits can be put also on a graph with fixed costs obviously being fixed. They never change, so that's your straight line. Your total cost, which is all the costs that you have, they start from the fixed costs because you can't go under the fixed costs because the fixed costs are always there, whatever your level of activity is. So from there they go up, and everything in the middle is your variable costs. So this dotted line right here, or this lines right here, this area, this triangle is your variable costs because it's the difference between the total cost and the fixed cost. And the break-even point is the point where the total sales and the total costs intersect. And the intersection point, it's basically where they're equal. It's where the total sales are then equal to the total costs, which is at the end of the day what break-even point is when your costs are equal to your revenue. Then target profit. There are 2 formulas you need to know to calculate the target profit. One considers tax and one does not consider tax. there are quite a few exercises that he gives you where he asks you, here you have an income statement. The company wants to have 100,000 francs as target profit. Please find how much it needs to sell in order to reach this profit. So the first one with tax is fixed cost plus your target profit that you want to achieve. The target profit is always given in text. Usually you don't need to worry about it. Divided by the contribution margin per unit. That's usually the one you need to calculate in the exercises. Very simply, like we saw before with the income statement, it's revenue minus variable cost. There you find your contribution margin, then you divide that by units sold. While if he tells you, and in the exercises, if he tells you, by the way, there's tax included, then you need to take the formula that considers tax, which is pretty much the same thing, except for you divide the target after tax profits, which the same is always given in the text. You divide that by 1 minus the tax rate. This way you eliminate the tax from your profit. And then you divide that by your contribution margin. And what you find for these formulas is basically how much quantity you need to sell in order to reach your desired profit. Then, the break-even point with multiple products. So, for now, we've only seen how to calculate break-even points considering there's only one type of product. Because if we go back, in this case, the contribution margin divided by amount sold, it works with the contribution margin is for one product. While if there are multiple products sold, which usually that's what companies have, they never ever sell one single product. They always sell more than one. There are two ways to then find your contribution margin and the contribution margin per unit that you then need. The first one is called the overall contribution margin. Now, I think it's easier to show it to you guys with some numbers. So let's take a very random company called EHL. Now, these are the units sold in one day. So the first one being EHL chocolate. EHL sold today 100 units of the chocolate, while probably a lot of Boss 3 students went drinking today after a disaster called SOM. So EHL sold a lot of cocktails of the day, 300 being precise. Now, these are two different products, and EHL needs to find the contribution margin in total of these two products. Well, the first way of doing it, so let's say that the sales of chocolate are these. The sale of cocktail, these are the numbers that they made. Now, what you want to do to find the contribution margin is sum up the sales, the variable expenses, and the contribution margin. And that is then the contribution margin of the two products put together. Meaning that overall CM ratio, you just sum up the two contribution margins of the two products, and there you have the contribution margin of the total contribution margin of those two products, and in this case of EHL, if they would only have two products. And then the percentages you can see on the side, that's the contribution margin ratio. And how would you then calculate the revenue break-even point? What you want to do is take the total fixed cost, the fixed expenses, which are always total. There's almost never fixed cost per product. Usually it's always the total. And you divide that by your contribution margin rate using the contribution margin you found by summing up the two contribution margin of the two products. That's the first method. The second method is called, sorry guys, the thing shifted. Well, you can see here it's method 2, weighted average contribution margin per unit. In this case, what you want to do is analyze the sales mix. Analyzing the sales mix is a very, very sexy word for finding the percentages of units sold. In this case, EHL chocolate sold 100 units, so 100 over 400, that's 25%. While 100 over 500 over 400, yes, that's 25%. While 300 over 400, that's 75%. So your sales mix in this case is 25% for chocolate and 75% for BDS cocktail. Then what you want to do is find your contribution margin units per product. So in this case, we have for EHL chocolate, the contribution margin per unit is 10. For the BDS cocktail of the day, the contribution margin per unit is 26. So what you want to do is do the contribution margin of EHL chocolate, which is 10 times their sales mix, which is 25%, plus the contribution margin per unit of BDS cocktail, which is 26 times 75. And that is then the contribution margin per unit of the two products put together using the second method called weighted average CMU. Now, the weighted average CMU works best for the contribution margin per unit. So that's what I would recommend you use it. I would recommend using it for the total contribution margin. For that, I would recommend you use the overall contribution margin method. Now, for operating leverage is pretty much the same as elasticity in microeconomics in BOSC 1. Honestly, I can't remember elasticity. I do not like economics. I do not want to remember it. So a very simple way of remembering operating leverage, it's a number, and it's a way of measuring how sensitive operating income is to the percentage change in sales. So if your operating leverage is high, then a small increase in sales will create a much bigger increase in profit. While if it's very low, the opposite is true. The operating leverage is calculated by doing contribution margin divided by profit. And if, for example, Dorky asks you in the exam, tell me how much do you think the operating profit will change, giving this operational leverage if company A increases their sales by 50%. So what you do is, to find how much profit will change, is you do operating leverage times the percentage change in sales. This way you find a clear number. Let's say you get 50,000. Okay, the profit will increase by 50,000. Then finally, we have something called a margin of safety, which is what a company uses in order to stay safe, in order to account for any losses, any unexpectancies that can happen. It's how much money a company can lose before they start to have negative profit. The margin of safety is calculated by doing the total sales minus the break-even point in revenue. If you guys remember from the past slide, the break-even point in revenue is the contribution margin rate divided by the fixed cost divided by the contribution margin rate. Now I have a little quiz that's directly from Dirk's quiz. So if someone wants to tell me which one they think it is, it's basically just which one you think is true based on what I just said on the operating leverage and the margin of safety. So if you want to write in the chat or unmute your microphone and let me know, that would be great. I'll give you 1 minute to think about it. Just which one do you think is true? There can also be multiple, A, B, C, or D. Okay, Maya, yep. D is true. Is that the only one that's true? Are we sure that that's the only one? Yes. B is true as well. And C, no, it's not changing contribution margin, it's change in sales. So it's how much your profit will increase depending on how much your sales will increase, not contribution margin. Good job, guys. So then, go. Okay. Then section 5 is job order costing. Job order costing is also a very sexy way of assigning prices to jobs. Very, very simply. And every single job has 3 types of cost. It has the ones we saw before. It has the DMC, the DLC, and the manufacturing overhead. Now, in order to assign costs, depending on the cost, some costs are very easy to assign. For example, the DMC and DLC. I mean material costs for the plastic bottle again. Let's say to produce one bottle. Let's say the job is producing one bottle. For your DMC, your material costs, let's say that's plastic in this case. Plastic very easy to calculate. Let's say it's 1 franc based on your shipping based on the cost of the manufacturer. Well, the DLC is the salary that you give to the labor that creates the water bottle, also very easy to calculate. While manufacturing overhead, as we saw before, it includes all different types of costs, and they are impossible to attribute to a single job because you can't attribute the electricity used over a year to create one water bottle. A quick example of job order costing. So let's say that the job is hanging up a painting. If you guys want to, if someone wants to unmute the microphone or write in the chat, what do you think the direct material cost of hanging a painting is? Let's see. Any ideas what the direct material cost of hanging a painting is? What material is used to hang a painting that's only used to hang a painting, basically? Any ideas? You can write in the chat or unmute your microphone if you have any idea. Yep, nail. Hang up a painting. The nail is definitely one that's used only to hang up a painting. The painting and the frame. A hammer, well, a hammer can be used for many things, not just to hang up a painting. So I put more the hammer as a manufacturing overhead, although the same can be said for a nail. But I think a nail is more used to hang up something, while a hammer can be used for more things. What do you think the direct labor cost is of hanging up a painting? So the direct labor cost is the cost of paying someone that does the job. Don't think it's the painting hanger. I did not know what to call them. The hanger. Yeah. The person basically doing the job. That's the direct labor cost. Well, manufacturing overhead, what do you guys think manufacturing overhead could be then? Since manufacturing overhead cannot be attributed to a single product. What is a good example of manufacturing overhead? Ideas with manufacturing overhead. One of them. Mainly manufacturing overhead is everything that's cannot be attributed. So the lighting, the heating, maybe the vacuum cleaner to clean up the debris after you put in the nail, the hammer, the air conditioning, if there's air conditioning. Like, it's everything that's included that's helps you do the job. It's included around the job. But obviously, as you can see, it's very hard to attribute the manufacturing cost to a single job very precisely. So what companies do is that they use something called a predetermined overhead in order to attribute the manufacturing overhead costs. Now, the predetermined overhead rate is a rate that's calculated at the beginning of a year, and it's the same. And a company will use this rate to calculate the manufacturing overhead of all of their jobs. Now, the formula for the overhead rate is the total manufacturing overhead cost divided by the total allocation base. Allocation base is basically the way that a company calculates their manufacturing overhead, and usually the allocation base is the thing that's used most in a job. So let's say, for example, the job is making a pancake. The allocation base will probably be labor hours, since that's the thing that's used most, because it's the thing that's most expensive, labor. So the allocation base can be machine hours, labor cost, or kilo of product used. It can be anything. It's always given. They always tell you in the exercise what the allocation base is. And then in order to find the manufacturing cost of a specific job, you take the rate that you've calculated by doing the total manufacturing overhead cost divided by the total allocation base, and you times that by the amount of allocation base used in that job. Let's say, for example, cooking pancakes, the allocation base is in labor hours. So you find your manufacturing you find your manufacturing rate, your predetermined overhead rate. Let's say it's 2. And we said that the allocation base for cooking pancakes is let's say it's labor hours. So you do the rate times the labor hours of cooking a pancake. That way you have the manufacturing overhead of that specific job. Remember that when using the rate and calculating the manufacturing overhead costs, it's an estimate. Companies always calculate the manufacturing overhead using the rate before the actual job happens, because they need a prediction. They need to know how much something will cost in the future. So it's an estimate and not the actual manufacturing overhead. That's an important detail, and it's something that I did a lot of mistakes on, but won't anymore. Because it's what the company forecasts. Then, I have here an exercise. I'll give you guys 5 minutes to do it using the predetermined overhead rate. I highlighted all the information you might need. Maybe you don't need everything. And as soon as someone has the answer, let me know in the chat. Or write in the chat what you think the answer is. Okay, we have a few people that have the answer. 21,875. That is correct. And so what you need to do is you have the total overhead costs. You divide that by the allocation base. You know that the company ASI uses machine hours as the allocation base. So what you want to do is the total overhead costs divided by the machine hours, which in this case is 4,000, and there you find an overhead rate of 87.5. And in order to find the overhead manufacturing costs of that specific job, you do the rate times the allocation base of that specific job. And then you simply do the allocation base for that job, so 250 hours times the rate, which gives you 21,875. Yeah, I guessed it was 5 and not 0.5. And one thing important for now, what I've seen in his exam is that almost all of his answers don't have a point. It's always full numbers. So if you get a very weird number, it's probably wrong. That's what happened for me in most of the exercises. Unless you get a rounded number, I would redo the calculation, because he's very nice. He always gives you round numbers as answers. That I find really great, because then you can be pretty sure if it's right or not. Then, once a company calculates the manufacturing rate, the year passes by, and they have on their budget actually what the manufacturing overhead was. So the applied manufacturing overhead is the manufacturing overhead that was calculated using the rate, while the actual manufacturing overhead is the one that actually happened while doing the job, or the one that the company actually incurred in during the whole year. Now if let's say, for example, that the company had the wrong rates, they maybe used more let's say that the allocation base was working hours, they used more hours than they thought they would. Well, in this case, the actual would be bigger than the applied, so the actual is higher than what they actually thought it would be because they used more working hours than they thought it would be. In this case, it said that the manufacturing overhead is underapplied. So if actual is bigger than applied, then the manufacturing overhead cost is called underapplied. In this case, the remaining balance is debited to COGS, cost of goods sold. While the other way can be true, maybe they think, hey, I thought that we needed 100 hours to do this. Well, actually, they only needed 85. In this case, the applied are bigger than the actual. And there, the difference gets distributed into different accounts. It can get distributed into work in process, finished goods, or COGS. Usually, it's a bit in all of the three accounts. Then, there's also something called service department costing. Service department costing is basically the services that a service department gives to an operating department. So a service department is anything that doesn't create revenue. It can be the IT department, it can be the management, it can be janitor. So anything that's assists the operations department but doesn't create revenue is a service department, while the operations department is the actual department that creates revenue. So that is the operations department can be a kitchen in a restaurant, or let's say a hotel has more departments. It can be the restaurant, it can be reception, while in the service department, in that case, would be housekeeping, it'd be management, it'd be HR. So anything that assists the operating department. And the idea behind service department costing is to find out how much cost to attribute to each operating department. I will show you guys later how to do it. It's basically how much. Let's use as an example as a service department the janitor. The janitor, he cleans the kitchens, he cleans the rooms, for example, he cleans different departments. And the idea behind service department costing is finding out how much money to allocate to each operating department. And the way of doing it is there's two methods. One is called the Direct Method and one is called the Step Method. We'll start with the Step Method. It's the more complicated one, but once we did the Step Method, understanding the Direct Method is much, much simpler. Now, the Step Method, it's a way of allocating costs based on units. So we can take the janitor again as an example. The janitor usually, he cleans the square meters, he cleans the floor. So obviously, an operating department that has a higher square meter will cost more than a department that has a lower square meter. Now, the Step Method, it also considers help between service departments. So the janitor, again, obviously, he doesn't only clean operating departments, he also cleans the office of the managers, for example. So that's a service given to a service department. Now, the Step Method, it's quite a long process to do. Every time he asks you to do it, I'm always like, okay. It took me also a while to understand it. Like, it's not something that's very easy to understand. It takes quite a bit of practice, and it's a pain in the ass to do. It's long. It's just something you have to do. It's very methodical. It's very robotic. It takes some time to understand it, but yeah, once you've got the hang of it, it's not that bad. Like anything. So I'll try my best to explain it to you. In case you guys don't understand it, we can always come back to it later. That's not an issue. So what you will get when he asks you to calculate the Step Method is you'll get a sheet with the different costs of the different departments. So in this case, we have management, cleaning, maintenance, production, and delivery. Management, cleaning, and maintenance are our service departments, while production and delivery are operating departments. Now, And what we know is that management has an indirect cost of 240, which has to then be allocated to different departments, cleaning 200, etc., etc. So what he will tell you in the exercise is, okay, management uses number of employees to allocate costs. Cleaning will use square meters to allocate costs, while maintenance will use working hours to allocate costs. Then, what you're going to do is, let's say he says, okay, management uses number of employees to allocate costs. Then what you want to do is, you want to take the number of employees, ignoring the management ones, because that's the cost of management. So you want to take the number of employees, so 10 plus 20 plus 60 plus 30, which in our case is 120. So that's the total number of employees. And then in order to allocate the cost of management, you use each number of employees times the indirect, divided by the total number of employees times the indirect cost of management. So the costs of that management would attribute to cleaning is 10 divided by 120, which is the total amount of employees, times 240. The cost that maintenance would get from management is 20 divided by 120, the total number of employees minus the management, times 240. Production will get costs from management will get 60 divided by 120 times 240, and so on. So what that would look like is something like this. Then cleaning. Then what you want to do once you have the first step of the cost, you find the total cost, and that's your first step done. Second step is cleaning. Let's say that cleaning uses square meters, because obviously you clean based on square meters. The more square meters you have, the more it costs. Same reasoning as management. So you take all the square meters except for the cleaning one. So in this case, 8 plus 12 plus 24, which gives us 44. And in order to allocate the cost of cleaning to the other departments, so maintenance, production, and delivery, what you want to do is so we have the total cost of cleaning, which is 220. So what you want to do is take the, let's say, cleaning cost for maintenance, 8 divided by 44, the total number of square meters, and then you times that by times the total amount of cost attributed to cleaning. So in this case, it's 220. We do 8 divided by 44 times the cleaning, times 220, which then gives us 40, 60 for the production, 120 for delivery, based on the numbers we saw before. And finally, for the working out, for maintenance, which is our last service departments, same thing. So we use, in this case, for maintenance, they use working hours. So the only two departments remaining are production and delivery. Because once the costs of the other departments have been attributed, so management have already been attributed, cleaning has already been attributed, these you can ignore. Don't worry about them anymore. So same reasoning. For maintenance, you do working hours, 30 plus 20, which is 50. You find the total cost. That's the cost of cleaning. This gives us a total cost of 325 for maintenance. To find the maintenance cost, you do, I think production was 30. So you do 30 divided by 50 times 325. That's your cost for production. And same for delivery, 20 divided by 50 times 325. That's your cost for delivery. And that's then how you find the different costs of the different service departments using the step method. We can come back to that later then in the second hour. Now for the direct method, it's similar to the step method, except for you ignore those. What that means is that you take the employees of only the operating departments. So the employees of the operating departments were 60 and 30. So that's a total of 90, because you completely ignore these for the direct method. So what you want to do is you want to do 90 times the management cost, 240, and then you attribute it to that. Basically, you ignore the possibility of management giving service to other service departments. But the direct method is very, very rarely asked, and he always asks for the step method, not the direct method. Okay. If you guys want to break, let me know in the chat. Just spam me. If you want to break or if you want me to continue, let me know in the chat. Okay, so no break then. Sounds good. So section 6, relevant costs for decision making. Now I have some good news and some bad news for section 6. Let's start with some good news and the bad news at the same time. It appeared. So the good news is there's not a lot of math. There's not going to be much formulas. There's not going to be a lot of numbers. So that's good. The bad news is there's not really a trick that works for the exercises. You'll see in a minute why. It's my least favorite chapter. I'm gonna admit that. It takes some practice, but the good thing is there's not a lot of calculations to do, not a lot of formulas. So what are relevant costs? Relevant costs are costs that must be taken into consideration when making a decision. This can be, for example, these costs can be rent, tuition fees, material costs. Let's say, for example, you want to choose between 2 schools. A relevant cost would be tuition fees, because each school has a different amount of tuition fees, so that'd be a relevant cost. It's costs that you have to think about when making a decision. Let's use an example. We have, you want to buy 2 cars, either a Tesla or a Mercedes. In your opinion, which costs are relevant and which costs are not relevant when choosing between 2 cars? Any ideas? Just unmute your microphone and tell me in the chat with which cost you think is relevant and which cost you think is irrelevant when having to buy 2 cars. Or you can unmute your microphone and tell me an idea that you might have for a relevant or irrelevant cost. I might start you with one, just to give you a little tip. A relevant cost when choosing a car, obviously the different cost of cars. A Tesla or a Mercedes, there's for sure going to be a price difference, so that's going to be a relevant cost. An irrelevant cost, something that has nothing to do with it, the cost you pay for maintenance of your house. It has nothing to do with the purchase of 2 cars, so that's why it's considered an irrelevant cost. What other relevant cost do you think there is? Any ideas? Alright guys, moved a bit. What's happening? Sorry guys. So let's see. Yeah, consumption, lease costs, definitely. Consuming costs, I'm sure one car consumes more than the other, so yes, definitely all relevant costs. Irrelevant costs, I'm not going to stay here to ask you which irrelevant costs there could be. There's a million different irrelevant costs. Could be anything from rent of your house, that's rent of your apartment. That's an irrelevant cost. It has nothing really to do with choosing between 2 cars. Now, there are a few tips and there are a few different types of costs. Mainly, what you want to do when deciding between relevant and irrelevant costs is, basically signaling out the irrelevant costs. There's 2 types of irrelevant costs. The first one is called sunk costs. The second type of irrelevant cost is called future cost. So a sunk cost is a cost that has already been incurred and cannot be avoided. So a very simple example of this could be rent. Let's say someone pays rent at the beginning of the month. That's a cost that has already happened and cannot influence a decision because you already paid it, so it has no way of influencing it. While the second cost is called the future cost, which are costs that do not differ between 2 alternatives. Let's go back to our 2 cars. let's say you pay the same amount of tax on the two cars, so that would be a future cost. Because the tax is the same between the two, so they are not relevant when deciding between which cars to buy. In this case, just to show you, the future costs would be the costs that do not differ, so that would be the selling price. This is the case when you want to buy a new machine. Future costs would be a selling price. It could be direct materials, while direct labor costs, obviously if you buy a new machine, you might need less labor, so that's definitely a relevant cost because it does change. Another future cost could be the variable overhead cost because it does not change between the two alternatives. Same as fixed cost. Well, the fixed cost of new machine, there's an extra fixed cost, so that's a relevant cost, something to consider when making a decision. Now, there are, thank God, a few tips when doing these type of exercises. There's different types of categories of relevant cost exercises. One of them is deciding whether to add a job, a product, or a product line. Now, what you need to consider when adding or dropping a product line are the fixed costs that you will lose or not have anymore if you drop a certain product. So once you identify the fixed cost that you will not have anymore once dropping a specific product, then you simply take the contribution margin of that product that you want to drop, you minus that by the fixed cost, and if the result is positive, you keep the product. If the result is negative, you drop it. So what essentially you need to find is the fixed cost that you will lose once you drop if you would drop the specific product. It's a quick exercise just to explain to you how it would work effectively. It's so we have a company that's thinking about dropping a certain product. You have here the contribution margin, which is 460,000, and the fixed costs that you would lose are all the fixed cost attributes of that product. As you can see here, all the fixed costs that do not disappear are the common costs, because common costs can be attributed to different types of product, not just one singular product. So in this case, the non-common costs non-common fixed costs are advertising, the salary, and the insurance. Depreciation is not a fixed cost because you cannot resell it, so it's not something that you would take into consideration if you drop a product. So what you want to do is you want to sum all of these up. You want to sum all these up, so you want to sum the advertising, the salary, and the insurance. And then you want to do that minus the contribution margin. And in this case, if you try doing the exercise, you sum up the three fixed costs, which are not common costs and which you would lose if you drop this product line. You do the 460 minus the sum of the fixed costs of the advertising, salary, and insurance. You get a positive amount, meaning that you should not drop this product line. Then there's another type of relevant costs to consider. That's if you want to produce in-house, or if you would like to have a manufacturer create the product for you. So the decision is whether to produce in-house or to have it outsourced. In this case, there's also not really specific rules. I'm sorry about that. But what you have to do, you have to find the relevant costs of creating a product in-house and eliminate the costs that do not change whether you produce in-house or you outsource a specific product. In this case, it's a specific product that could be outsourced for $21 per part. Right now, it's being made in-house for $25. What the relevant costs in this case are direct materials, because direct materials is something that it's a cost you have if you create it in-house. If you do not create it in-house, you do not have a direct materials cost, which is why it's relevant, because it does change depending on whether you choose to outsource or to make. Direct labor, same for that, you need someone to make it. If someone makes it for you, if you outsource it, someone makes it for you, you need to pay them. Variable overhead, well, it's variable, so always be there if you make something. Fixed overhead in part, because in this case, it specifies that 2/3 of the fixed overhead being applied in part S6 would continue even if S6 were purchased from outside supplier. So the fixed costs that would continue, you would have them in any case, whether you outsource or you create in-house. So those are irrelevant, while the 1/3, which would disappear, those are relevant because obviously they go away if you outsource. And what you want to do is sum up the relevant costs. If they're bigger than the cost of outsourcing, you outsource because it's cheaper. If it's smaller, you make it in-house because you want to always obviously choose the cheaper product, the cheaper option. Then the chapter also talks about something called joint products, which is a product that is made together and then is then produced to create two separate products or many separate products. A good example of this is oil. It starts off with crude oil, and oil can be made into many things. It can be made into gas for cars, airplane fuel, jet fuel. It can be made into, I believe, boat fuel is different again. So it's one product, then that's once it's processed can be transformed into different products. And the moment it gets transformed into different products is called the split-off point. A typical exercise which would include joint products is this kind of exercise, in which he tells you, okay, you have 3 different products with a sales value of 50,000, 90,000, and 60,000, which can be processed further. These are the additional processing costs are 35,000, 40,000, and 12,000. And the value they would have after being further processed are 80,000, 150,000, 275,000. What you would have to do in this type of exercise is start with the sales value after further processing. So that's the highest sales value it can have. You minus that of the sales value it has at the split-off point. So before it gets processed into more refined products. You minus that, you find the incremental value. Then if the incremental value is smaller than the cost of further processing, you would have a negative differential revenue, so that in that case, it's not worth it to further process. While if it's positive, then I would definitely recommend to further process it. And this is the type of exercise you can have with joint products. So I would also recommend to just putting this solution into your cheat sheet, so then you have it, you can use it as a base for any single exercise for joint products. Then section 6 also has a section on bottlenecks. I don't know about you guys, but I've had more than enough bottlenecks for today, especially this morning. So, and we've all seen it way more in detail in SOM than we would in MA. So I've decided to skip that part. It's just what we did in SOM, just much more in general. So yeah, if it's all stuff we have seen in SOM anyway. So we have 2 more sections to go, and then we're done with the theory. The section 7 is all about budgets. A budget is another name for a forecast. It's what a company thinks, how much they will spend, how much revenue they will have. That's everything that will be put in a budget. So in a budget, you'd have your revenue, your costs, your labor costs, the different costs, and then how much profit you predict you will have. So obviously, because of it's a prediction, budgets are always done at the beginning of the year. It's a detailed plan of the future, as I said. And there are different types of budgets. One of the most important ones is called a master budget, which is basically a budget of the entire company with all the departments, all the branches, all the subsidiaries, everything in one budget. This is a typical type of budget. Okay, you can't really see it that much, but you can see like the actual and the predicted. The predicted is the budget part, then the actual is the actual then products, the actual costs that have been incurred throughout the year. Except for the master budget, there's 3 other types of budget. One is called the participative budget, which is basically where managers of different departments create their own budget and then send it to upper management for approval. And then all the participative budgets get put together into one, and that's then your master budget. Now the participative budget, it's good because it creates motivation, because the managers can predict their own revenue and their own costs. So it kind of motivates them to actually realize those goals. But it can, depending on the manager, it can also lead to something called budgetary slack, which is the idea of underestimating revenues and overestimating costs. So if a manager underestimates the revenues and overestimates the costs, then it makes his life easier. And that's the risk with participative budget. The second type of budget is called incremental budget. It's basically a way of preparing a budget by using last year's budget. So let's say last year's budget was pretty accurate. You would use that budget to then prepare next year's budget, basically copying the numbers from one year to the next. The last type of budget is called zero-based budget, in which one person or one team creates a budget from scratch, from zero, taking into consideration many different factors, many different costs, and it's the most time-consuming budget of all of them for obvious reasons, because you start from zero every year, but it's the most precise one. And what's usually in a master budget? So in a master budget, you have your sales budget, which is how much revenue you think you'll have. You have your production budget, which is how much you think you will produce. You'll have your selling and administrative budget. You'll have your direct labor budget, which is your labor costs, how much labor costs you think you'll have. And all this leads finally to your cash budget, which is then how much cash actually you think you'll have. So all the ending inventory budget, direct material budget, direct labor budgets, all the blue budgets, they're all costs, and they're all made based on the sales budget. Because obviously you don't want a budget that your costs are higher than your sales. So you start out by creating your sales budget, and then you minus that by all your costs, and then you create your cost budget based on how much you think you will sell, how much revenue you will have. Now, there are different types of budget. So every single point of the master budget has different ways of being calculated. Durkee shows 3, I believe. So that's the 3 that we need to know for the exam. The first one is to calculate the total sales, the total cash sales, or the total revenue, which is simply done accounts receivable plus the total sales of the period minus the accounts receivable equals the total cash collection for the period, which would be the cash budget. And then that's an exercise that we can do. Unfortunately, we're a bit running late, but we can do it later than during the Q&A. The second type of budget that you need to know how to calculate is the production budget. There you have your budgeted sales in units plus your desired ending inventory. Usually what he puts in an exercise is he tells you, I would like my inventory to be 20% of next month's starting inventory, or next month's inventory. Next month's total inventory. That's usually what happens. There you find your total needs minus your beginning inventory, which is usually given, and then you have your required production. And finally, he also gives the formula for the direct materials budget, which is how much raw material you need to produce what you need to produce. And there you have your desired ending inventory plus the raw materials you need, which is all the raw materials you will need, minus the beginning inventory, and that is then the raw materials to be purchased, which is what you need to know, because you need to know the costs, so what you need to buy for that year. And then there's something called a flexible budget. A flexible budget takes because ideas can change, plans can change. So flexible budgets takes into account changes in revenue and costs as a consequence of changing activity. Let's say that in the middle of the year, for some reason, they produce way less than they thought they would. So a flexible budget gives them the possibility to very quickly change their estimates. So they can very quickly, let's say they thought, we would create 100 water bottles, so the cost of plastic would be 100. Oh damn, we're making less water bottles than I thought, so let's decrease a bit the cost. And that once they decrease in the middle of the year, that will be then called a flexible budget. Finally, last chapter. I promise last chapter, then we're done. Last chapter only has a few formulas. So last chapter's variance analysis. Variance analysis is is based on also the chapter 7. It's basically analyzing what you thought, so the budget, and then what actually happened. Variance analysis involves finding out why something happened. So that's a variance analysis cycle. So you start by creating your standard cost performance. Standard cost performance is what you expect. And that's also kind of your budget. You find your variances, you question what happened, you try to find explanations, you take corrective action, and then you go on to the next periods of operations. And then that you do every time you do a variance analysis cycle. Now, the formulas needed for variance analysis are the price variance, the materials variance. Materials variance is also known as quantity variance, labor rate variance, and labor efficiency variance. Labor efficiency variance is how efficient the labor was. Labor rate variance is the salary, basically. And yeah, in the exercises, he always asks you to find the price variance. So you take the actual quantity that was used, times that by the actual price minus the standard price. All these AQ, AP, SP, SQ, they're all values that are given. They're always given in the exercise. And from there, you just calculate the variances that he asks you using these formulas. And he always asks you if the result is favorable or unfavorable. If the result comes out negative, it's favorable. If it's positive, then it's called unfavorable. So basically the result of any of these formulas. Then that's a few exercises that we can do then later on. And I promise then that is the end. Something that I always tell my friends, it's important, good luck for the exam, but most importantly, enjoy it and have fun. Because if you don't enjoy an exam, it means you're stressed about it, it means you're worried about it, and then it will go not well. So yeah, thank you very much, everyone. Now, if you have any questions, let me know. And otherwise, I wish you a great evening. And I hope that I helped you understand MA a bit more. And I'll be at school tomorrow, basically the whole day. So if you see me have any questions, please come ask me, show me an exercise you don't understand,